So, Matthias, thank you very much for having me on today. I'm going to talk about Finexity and what we're building. On a very, very high level, we are really reinventing capital markets. The way you see capital markets today will not be how we see it in the next 5 years. So, what is it that we are building at Finexity? Here we go. Finexity in itself went public last September in its primary listing in Munich, and ever since we've also done our second listing in Frankfurt, also now being listed on Xetra. We're a public listed infrastructure provider for tokenized capital markets. And what that means, I'm going to talk a bit more about over the next 20 minutes. Over the years, we were back in the days VC funded, so we raised over 27 million euros and then decided to take the company public because we believe that in our business model that is partially focused on democratizing public markets and private capital markets in a more efficient way. We believe that that was the right step forward, and it has proven to be that way ever since. Over the last couple of years, we facilitated over 250 different bond listings. We operate in 4 different asset classes. Through our platform infrastructure, we've had over 84,000 registered investors facilitate trades on the primary as well as secondary market base. We're active across 5 different offices, and our business is split in two business units. One of them being the capital markets business unit, so very traditional banking kind of like investment banking kind of setup where we advise, structure, originate, and place certain securities. And on the other hand, and that's really where the true value of our infrastructure lies, is in the exchange business, where we provide the infrastructure for a new capital market for tokenized securities. Now, I've talked a bit about the company setup. However, there is probably a few words that you're not very familiar with, so I want to dig into detail. Now, the vision of Finexity is really providing an infrastructure for the new capital markets. And what you've seen over the years is that there's now multiple stock exchanges, for instance, the New York Stock Exchange, that is building a second exchange next to their current exchange that is solely going to be focused on tokenized securities. So we've seen over the last couple of years, the tokenization was at first driven by retail money, has now institutionalized a lot. And now you see a lot of institutional players that are coming from the infrastructure sector that will now provide the right infrastructure in a legally compliant way to, in the end, trade these securities. And that is exactly what we're building. We're building the leading exchange for tokenized securities. What we currently have is an OTC marketplace that we will turn into an exchange. In an exchange that is an MTF, so a multilateral trading facility, that is the likes of TradeGate, GetEx, the ones that you know, plus a settlement system. And why we're building also a settlement system integrated into the exchange, I'm going to talk about a bit later. Now, when we now roll out our exchange and our OTC marketplace that already exists, we are solely focused on private market investments at the minute. When we talk private market, we talk corporate bonds, unlisted companies, we talk real estate, we talk infrastructure, and we could talk other asset classes that are currently not accessible by both usually institutional, but also retail money. And we believe that tokenization has the largest impact in these asset classes. And that's the reason why we're focusing on those. And that is also a major difference to a lot of other exchanges that are now building similar business models to what we have built since 2018, is because they are focused on public capital markets. And we don't want to compete with the likes of New York Stock Exchange by building an exchange for tokenized securities, because we know that they've got obviously more significant money, they've got a different target group, and they really want to penetrate the equities market. Whereas we believe that in our private market sector, focusing on bonds, funds that are linked to private market investment opportunities, we've really streamlined our process and grown significantly over the last couple of years. Now, when you invest into Finexity and the stock of Finexity, you're really investing into an infrastructure provider that has shaped the European capital markets over the last couple of years. The reason being is that we were one of the early adopters. So when we got into the space in mid-2018, there was no regulation. We built parts of that regulation. We have a very good relationship with the regulator. So when we advise them on where can we move ahead, what has to be built next in order to facilitate the trading, the settlement of tokenized securities. So that way we, yes, have spent a lot of money on our infrastructure development. However, we've really built that market in a way where we've always worked with our clients, either issuers or trading partners, such as banks, wealth managers, to build an infrastructure that is actually now being used in comparison to a lot of other companies that are now coming into the market and building infrastructure, but for zero clients. And we've obviously built that up over the last couple of years. Now, I really want to take the next 3 to 4 minutes to talk a bit about the market opportunity in itself. Tokenization is to stay. There's a study from McKinsey that shows by 2030, in a base case scenario, 1.9 trillion US dollars of securities will be tokenized. Now, we believe out of that, because I initially explained to you that we don't want to compete with the likes of New York Stock Exchange or NASDAQ or Deutsche Börse or Börse Stuttgart, and all of them are building in another exchange for tokenized securities because they know that it's coming. But we don't want to compete with them. We're focused on our segment, and our segment entails unlisted equities, debt, and funds, and that's where we're home. We've built over, or we've worked on over 250 listed bond issuances over the last 6 years, and I've got significant track record. And we worked with multiple issuers across certain asset classes, and we understand how we can tokenize bonds. And we are also now working on the first use cases in order to tokenize funds. However, the equities of listed equities is something that we leave to our rather larger competitors. Now, the key driver of why tokenization really works is because of three different things. Number one, it was back in the days retail. Now it's really institutional driven. Large issuers such as Siemens and others are working on the issuance of tokenized securities because it's so much more efficient. There is significant regulatory clarity in Europe. That refers me to the third point is that we are able through our infrastructure to reduce the number of intermediaries that take a cut in every single securities transaction. The reason being is because we have programmable securities, including instant settlement. What that means, I'm going to talk about in the next slide. Now, the landscape, and I think that's really important. In 2018, we were one of the only kids on the block, but we knew that this is going to happen. So we built the company. And that's why we raised the 27 million to really build a proprietary infrastructure that allows us today to trade and settle. Now everyone is catching up. Traditional exchanges, all the banks, other institutional players are now in the market. And there is already some other competitors that are also more in the startup space, such as 21X or SDX, which belongs to, which is a SIX company out of Switzerland, Axiology, 360X. But what really separates us is that we've built it up from the bottom up rather than top down. Now, when I talk about cost savings, the cost savings that we can portray through our infrastructure level are significant. It is expected that by 2030, around 4.6 billion euros will be saved in costs every single year in the European capital markets alone, thanks to tokenization. And we save those costs in clearing. I don't need an intermediary anymore that clears the transaction. So if you sell me a stock, it is immediately cleared between the two of us. The settlement doesn't happen T+2. It happens T+1 millisecond. So it's immediately second. And that means no risk premium has to be paid anymore. So we're really eliminating the clearing system. We are improving the settlement. We are significantly reducing the risk premiums being charged up until 2030, 100%, because a lot of the people and market studies believe that by 2030, every single security out there that will be newly listed will be tokenized. So it's a massive market. The custody side of aspects I can improve as well by around 1.7 billion euros per year just by having programmable securities. So that means there's there's significant efficiency. And asset servicing is also being reduced. However, that is not a massive cost trigger. Now you understand, okay, tokenization is to stay. It's getting into an institutional market. There is players in the market, but what really separates us is that private market focus. And private market in itself is something where retail investors, which is our primary target group at the moment, do not really have curated access to. And the private market space is growing significantly, but the access for retail investors is still not there. And that's what we're changing, because we believe private markets has to be part of your core asset allocation. There is a massive structural shift from public to private markets. However, there's significant illiquidity in the market. Or on the other hand, there's significant limited liquidity. And through tokenization, we are building a more liquid private market space. And all the alternative asset managers, such as KKR, Blackstone, Apollo, all of them have already worked on tokenization solutions because they know I can target a different target group. I've got lower OPEX on every single transaction. I can reduce the frictions in every single transaction, and I'm saving expenses. And that is also why some of the other digital private market platforms exist, such as Moonford, Liquid, ADDX, Securitize. And I would say if you look at our business model, the way we operate, we are probably very similar to Securitize out of the US. Now, but this makes us really special is that we operate in the intersection of two fast-growing capital market segments. We've got the tokenization space that we really understand well from a technological perspective, but we also understand private markets. Now, how do we make money and how do we operate? I previously told you that we operate across two different business units. We have the capital markets team. We advise issuers. So any asset manager out there, we go there, we pitch, we get advisory mandates. We then structure securities for them. If we actually are the issuer ourselves, and that's what we did back in the days, but it's not our primary focus anymore to build up that marketplace because no one wanted to work with us in the first 2 years because we didn't have any track record, which is very different now. We also receive carry and performance fees and have obviously asset management fees. We then list those securities that we've just structured on our OTC platform. There we list. We receive market participant onboarding fees. So an issuer, if you want to list, similar to any exchange setup, you pay for onboarding fees. We then have a admission to trading structure and onboarding process. We get tokenization fee, which is very similar to what you usually pay for the securitization, issuance fees, and then we get yearly product maintenance fees and registry fees. Now, on the primary market base, I now have a security that we've structured. It is now listed on the OTC platform. And then that needs to be distributed, right? And I think that's where a lot of companies fail. They might build the technology, but they don't have access to the right issuers nor distribution channels. And that is really the core of our business model, where we know that we can orchestrate distribution. And we can orchestrate distribution both institutionally speaking, but also we have a significant retail orchestration process. And that really separates us in the business again, that when you come to us as an issuer, we orchestrate that primary market distribution. We receive syndication fees. And then on the other hand, if we distribute it to our own B2C clients that we also run, we get a placement fee. On the level below that, we've taken over, which is still under the ownership control procedure with the BaFin, but we've taken over a larger liability umbrella company that has 45 tied agents working for them, that's facilitating over 100 million euros per year in primary market distribution, just retail, let alone institutional, which varies significantly from year to year depending upon deal sizes. But with them, we are orchestrating even more order flow on the primary market base. Now, how does that work, and what kind of clients have we worked with? So we've really proven that we have an OTC trading venue that works, as well established, that has a scalable target operating model. We work, as I said, we've got multiple use cases that we've worked on over the years across corporate, real estate, infrastructure, over 250 listed bonds. And then you see here the trading partners. So we work with the savings bank organization. We work with the Volksbanks. They're directly connected to our OTC infrastructure. So let's say we list something on the OTC platform. We then syndicate with them. We have multiple other wealth managers and platforms that are connected to our OTC platform just to make sure that there's enough order flow coming from the end investors. What is really the success formula of FINEXITY? It has 5 different things that I want to talk about. Number 1, we have an in-house origination team, which means that we use our infrastructure to list securities that we bring on board. So you could see us as a bank that then also runs an exchange. And currently, on the capital market side, we're solely focused on debt instruments. So we do predominantly bonds. In the future, however, we will also expand into the fund segment as a class and also equities as a class. Equity as a class, again, focusing on unlisted equities, predominantly pre-IPO. Now, with that, we have the ability to speak to the issuers help them structure, advise, but then also use our proprietary infrastructure to make the deals work, including our retail orchestration. Now, on a second level, it's all about distribution. You can have the best infrastructure, you can have the best offerings. If you cannot distribute or orchestrate distribution, you're going to have a problem. And that really separates us, that we work across three different main channels. We have the FINEXITY group. We operate three different brands. So under the FINEXITY group, we operate three different placement brands. We have now over 10,000 registered investors that have invested with us over the last 5 years. Now, what are we changing in 2026? We have signed a significant contract with the Igro Media Group. The Igro Media Group is one of the largest publishing houses in Germany. They have 10 million potential retail investors. They have over 15,000 newsletter carriers as tipsters. And the Igro Media Group owns 72 news. They own 72. Oh my God. Now I forgot the word. Newspapers. Thank you. They own 72 newspapers that are being read by over 10 million retail investors every single week. And the media value that we're receiving from them to publish investment opportunities is equivalent to 20 million euros a year. So in other words, we're getting 20 million of free marketing spend for our own products to really drive retail investor exposure. On the second level, we work with banks and wealth managers. Now, this is a very, very important thing. You need to understand that through our established partnerships with the Savings Bank and the Volksbank, we can now roll out the infrastructure across both banks, targeting up to 50 million retail investors over the next 2 years. We've done all the work with them. Over the last 5 years, we signed the first contract with the Savings Bank at the end of 2022, in December 2022. And ever since, we've been working on the technical integration. That technical integration has been closed and signed off and has all been programmed. So now you can access our OTC marketplace through the online banking, for instance, of the Savings Bank. So execute orders straight away. But that obviously is long lead times to make those things happen. We've done it, and now we can scale in 2026 and 2027. And then with the takeover of the liability umbrella, as I previously mentioned, 45 tied agents, over 70,000 registered investors, 100 million euros plus in retail facilitation every year. We are now moving that and scaling that even further, migrating the tied agents onto our infrastructure, more syndication happening on a primary market base to the 40,000 active registered investors, but also reactivation of 30,000 non-active registered investors that have not invested with them in the last 3 years. Now, what you can see from this is that we're really driving B2C distribution through the Igro Media Group is 20 million euros in marketing spend every single year. Just to put this into perspective, those 20 million, we believe we can probably tenfold our registered investors in the next 12 to 18 months. Then the rollout over the Savings Bank plus the full post-acquisition transformation of Effecta into our ecosystem. Now, on the third level of why we're successful and what we're building in 2026 and 2027 is that we're evolving from an OTC marketplace into a pan-European DLT-based infrastructure. We've been running a secondary market for tokenized securities on an OTC base since 2021. No one else has really built a secondary market ever since because it's a complex system. Now we're transferring that into a DLT trading and settlement system. And that's what you can already see on the right-hand side of what this is going to look like, where we're building an institutionalized setup that allows the trading and settlement of tokenized securities. Now, another really important point is that what's the true value of FINEXITY? The true value of FINEXITY long-term wise, so I'm talking mid-guidance, is proprietary infrastructure. We've invested multi-million dollars in investments into our infrastructure. We've got 3 core products. We've got our OTC trading venue, including settlement systems. We have the trading partner software as a service business that banks use and wealth managers use, such as the Savings Bank. And then we're going to be launching in Q2 2026 a single product subscription box that will allow issuers to raise directly from a single product perspective. That becomes very, very scalable for also smaller companies. Now, the 5th point, and I think that's really important as also a share value creator, is that we believe in inorganic growth. When we speak about inorganic growth, we want to vertically integrate across the value chain of tokenized securities. We focus on first buying companies that are in the trading partner slash investor space, meaning we want to scale even more distribution. And once we've bought more companies in that space, we will then on a secondary focus to build quicker, also looking at tech companies that can supply certain technology to our OTC infrastructure. We've made 2 transactions so far, always on a pro forma base with Effecta, because the ownership control procedure is yet to be finished. But we are already working on some slow integration projects. And on the other hand, we've brought a Swiss company called Crowdly Token that is on the one hand side, enabling our investor base to participate from the Swiss real estate market. And on the other hand, also distributed to the existing clients. Now, just for you get a quick feel for how we work, I just want to focus on 2 quick case studies. We advise, we structure, we syndicate, we've got the technical setup, and we do the asset management in some of the instances. So we separate into 4 different, we classified our clients into 4 different categories. Either it's us as the issuer, or we come in as an equity partner, as a lead manager. So we often come in as an equity partner because we believe in the projects that we actually structure, distribute, and orchestrate the distribution of. We sometimes already only just work as an OTC infrastructure, or we come in as a lead manager. Now, when you look at this, these are 4 examples of how we usually operate. So, for instance, we were the issuer of a secondary transaction of a US fintech. So that's very similar to the way that Robinhood did it. They definitely copied us because we did it before them. So you buy stocks of a private company, you wrap them up in an SPV, and then you distribute and you raise capital through an OTC structure from retail investors or institutional clients. We did that for the US company Acorns. They're worth around 2 billion at the minute. Then we also facilitate a lot of transactions in the real estate space. For instance, where we come in as a lead manager. I'm sorry, that's a bit wrong. It's the other way around, not OTC infrastructure and lead manager on the bottom end, where we then take care of the whole deal. So we facilitate the senior debt that came from Goldman and from Stronghold. We then provided the mezzanine. The total investment into that project was around 35 million euros. And then also on an equity base, we did a couple of developments on Mallorca, for instance. And then there is other things where it's just the infrastructure that is being used, for instance, by the savings bank, where they bring it on a bond listed on our exchange. We don't have to do anything, and we make money on every single transaction. Now, let's talk the next 2 minutes quickly about our performance. In 2024, on a pro forma consolidated base, total revenue was 7 million. That is being split into exchange and capital markets. Exchange, that's our technical infrastructure business, including the umbrella liability. That came up to around 4.9 million euros. In capital markets, that was 2.1 million. So that's just the advisory, structuring, syndication, and placement. We believe on the short-term guidance, we will increase our revenue to over 10 million euros. However, we will still be slightly negative. Midterm guidance-wise, we believe that we can expand revenues to over 70 million euros, predominantly coming from the exchange business, our scalable business unit. But that is also enabled by our capital markets business, which will come up to around 20 to 30%. And we expect EBITDA margins of around 25 to 30%. Now, to put this into perspective, to achieve this on a midterm guidance level, we would need an applied market share of 0.3%. Now, you can imagine, obviously, if we can increase that market share at that point, revenues and EBITDA will also significantly scale. Significant proportions are still held by the management as of today. And we have long lockups with our investors because they believe in the company, they believe in the structure of the company. So from that perspective, we're all aligned from a shareholder and founder perspective. The board has a significant expertise across various markets in banking, M&A, tech, and private markets. I co-founded the company back in 2018. I'm running the company as the CEO of the FINEXITY Group. I have the deputy CEO with 32 years experience at Deutsche Bank, who's previously running the private clients business, so retail as well as private banking for Deutsche Bank, our CTO and our CFO. Now, why you should invest into FINEXITY? We have a proven business model. Yes, we're a young company, but we have a proven business model. We're generating revenue, post-revenue stage. We're here to scale. We have a good technical setup. We have a business unit that is profitable. That's the capital markets. However, we're still investing significant amounts of money into our exchange infrastructure, which means that that one is not yet profitable. It's a $1 trillion market opportunity. Every single security will be tokenized in the future. It's just a matter of time. Am I as bullish as others that 2030 is going to be the year when there's only going to be tokenized securities? No. However, I believe there will be a significant proportion of the market. We act local, but we also think global, and we grow inorganically, meaning that we focus on the acquisition of good companies that are aligned with our strategy. We have a strong founder and shareholder alignment, and we have a very diverse background of the management team. Now, thank you very much for your time, and I'm looking forward to any questions that you may have.
Thank you so much. We have already a few questions in the chat. So first of all, how much capital has been invested in the platform so far?
The total investment into the platform has been over $10 million.
And what further investment has to be done to have a marketplace ready under BaFin regulation?
It's already the OTC market as it stands. It is already running on a regulated manner through investment brokerage. Through an investment brokerage bulletin board infrastructure. We believe that from an infrastructure perspective, just from a tech perspective, we believe another $2 to $3 million will have to be invested into the expansion onto to finalize the DLT TSS, which is in the end the MTF, including the settlement system. The reason why we need, if you were to phrase it in such a way, only that little money for this infrastructure is because A, we've already invested significant amounts, B, we have an operating system that works, and C, we have a target operating model that is proven.
And for the midterm guidance, you have a very solid EBITDA margin outlook. What are the main operational levers that will drive this market expansion over the next couple of years?
Very, very good question. So number one, when you look at traditional exchanges, their EBITDA margins are usually, let's say, around 40 to 50%. That is pretty normal for exchanges because they're infrastructure companies. I think a lot of people forget that. And they're traded with PE multiples of 25, some are 30, some are even larger than that at the minute. The scalability and the driver for our businesses, and that's why we have lower EBITDA margins than traditional exchanges, is because we're still building the capital markets or a new capital market. So we have to invest into the capital markets team, which obviously has lower EBITDA margins than the revenue, than the EBITDA margin that's coming through the exchange. And that's why our EBITDA margin is sitting at only expected 25 to 30%. So from that perspective, the exchange business in itself will have three core drivers over the next couple of years. It's the further access to banks, wealth managers. That is a very, very scalable setup because it is one infrastructure. Once you've built that infrastructure, you can then trade and settle as many transactions as you want. That's number one. The second layer is that we're going to expand across multiple asset classes. The asset classes have certain different or have certain key differentiators that need to be programmed. However, because of our setup as we have today, we can already facilitate also funds, for instance. And the third layer is that you're independent, or like the EBITDA margins will rise for the exchange business even more because it doesn't really matter whether we have 1 million trades per day or 5 million trades per day because the systems are built to scale. And those are the three major drivers for the EBITDA margin to improve long-term wise.
Okay. The time is up. Thank you so much. Maybe for some closing words, why is now the time to invest in FINEXITY?
Proven business, good outlook, short-term as well as medium-term wise. Plus the market is moving in the right direction because it's being institutionalized. And FINEXITY is one of the front runners, and we understand the traditional capital markets. And that is a big, big difference in comparison to most tech companies out there because we come from the industry. We know how to talk to issuers. We know how to talk to banks. We know how to talk to wealth managers, but we also understand tech. So that is the key component that we've built up over the last couple of years. So we have the track record that will enable us to scale even further in the future.
Paul, thank you so much.
Thank you.